So if you've been following this channel for a long time, you know that I am a hardcore believer in real estate as an investment. For me, it was the thing that changed my entire life, albeit also the thing that caused me a lot of stress as a child because it caused a lot of financial stress for my parents. But I've seen how powerful it can be. And in my own life, I've leveraged real estate to start businesses, to, have as cash flow properties. I've used my primary residence to leverage like a better lifestyle. And so I feel so passionate about it, which is why I work in housing. It's why I created this YouTube channel. But like I said in my last video, it's not enough just to hear it from people like me. Having Nick break down why housing is an investment, all of the different added value that it provides to people in terms of utility, it's just a game changer. So I hope that you love this presentation. And if you find it valuable, please send it on to a friend or family member. And don't forget to like, comment, and subscribe.
Housing as an investment. And, we're just going to kind of go over some data and kind of go over some high level stuff and just talk about why I still think US housing is a great long-term investment and why there's lots of incentives to keep it that way. So to start, I will show the US housing index since 1890. This is from, Case-Shiller index. You can see for most of US history, I mean, besides like obviously the Great Depression is this very specific period here, US housing didn't do much. Remember, this is the inflation adjusted real housing index. So like a house over time would still be worth roughly the same. It didn't lose its purchasing power or anything like that. So over time, this kind of was more or less, flat, at least over 100 years. I mean, yes, it did go down a bit in the Depression, but it wasn't until like the mid 1980s, there's a bunch of government programs that basically try to encourage more people to borrow, to get into housing. And that's why prices started to go up. Obviously in 2000, we saw this. This is the housing bubble here that we know. And then this is kind of what's happened, since the recovery in 2012. So on average over this period, US housing returned about 0.5% per year after inflation. Now, remember, this is just the price appreciation. So 0.5% a year above inflation over this entire time period, right? So basically kept pace with inflation. This doesn't include like what you would call the yield or what someone would call a cap rate in real estate. Like let's say you owned one of the a house and you were renting it, you're getting paid that income over time. On top of just owning it, there's like a yield you're earning on your return. So if you assume a cap rate of, 3 to 5%, you can assume more or less. You could say, US housing returns about, let's say 4 to 6% a year real, right? And that's great over this long period of time. Most of that period, it didn't return as much, but let's just say 3%. There's a big range you could give. Compare that to the US stock market. Over this period, US stock market returned about 7% a year, to say, compared to, let's say, 4 to 5% for US housing. Like, well, yeah, obviously stocks are a better investment, but they're a better investment, but they're way more risky. Housing is far, far less risky than the stock market, right? And so while, US growth has been great for the last 100 years, I have no idea if that's going to be true for the next 100 years. And this chart shows like the type of risks you take with stocks versus, housing. And so what this shows is the percentage decline from an all-time high. So basically, how much did the price drop from its peak to the trough? And you can see here, US housing during the, housing bubble, once it popped, was down about 25%. US stocks over this period popped or had two basically 50% declines on different declines, which were kind of unrelated. This is dot-com bubble. This is obviously the financial crisis, which was related to housing. But it goes to show, and remember, stocks have at one point had, drawdowns of 90% in the Great Depression, right? I don't know what the housing drawdown was. It definitely wasn't 90%, but it goes to show that like, stocks are at least 2 to 3 times riskier for just a couple more percentage points in return every year. So that's something to keep in mind. Another thing why I think housing is important as an investment is because it makes up a lot of people's wealth. And what this chart shows on this y-axis here is the net worth tier. So let's say someone had $10,000 to $100,000. Or 100,000 to $1 million, or $1 million to 10 million, et cetera. And how is their wealth broken down, like across everything they have? So if someone with $10,000 to $100,000, they may have, I don't know, what is this, 30% of their wealth in just their cars, right? They may have, 40 or 50% in their home, et cetera. And the thing that I want you guys to notice about this chart for now is primary residence. For those that have 10 to 100,000, 100,000 to $1 million, which is most Americans, that makes up the bulk of Americans, their primary resident is how they, generate wealth and save wealth over time. Even though it's not necessarily liquid, it's how they store wealth, right? It's a huge piece, right? So something to keep in mind. Like that is very important. And I don't think this is going to change anytime soon, right? I don't think this is like all of a sudden everyone in this bucket is all of a sudden going to start buying stocks or something else. Like I don't foresee a major change there. I think the primary residence is still the main way in which most Americans, middle-class Americans, build wealth. With that being said, I love this quote from the National Association of Realtors, which says homeownership is the largest source of wealth among families, with the median value of a primary residence worth about 10 times the median value of financial assets, right? So maybe this will change a little bit in the future. I don't expect it to be like, oh, it's 2 times more. No, I think it's going to be a much larger fraction. I don't think financial assets are getting necessarily more popular with people, especially after what's happened in 2022. Homeownership is still the American dream. This goes back to the 1960s. It's going to be anywhere between 63% to 60, let's say 9% of Americans have owned their own home, right? I don't think this has changed anyway. This right here was obviously what happened in COVID. There was like a lot of stimulus money that allowed people to, own homes, and things obviously changed after that. So this is like, I think homeownership is still the American dream. It was the American dream during this period. As I said earlier, there's this 30-year period where people are still buying homes, still doing all this stuff. And like, I don't see that changing. I don't foresee that changing in any way. The other thing to note, is like, I love this quote from Steve Randy Waldman, where he says, economists describe houses as a form of capital that provides a stream of services rather than a cash flow to owner occupants. We've been talking about housing as just like a financial asset, but it really is a lot more than that, right? The streams of services could be like the schools right near your home. It could be the amenities. There could be all sorts of services that a home provide. So it's not just a financial investment, like which it can be, but it's more of like a life. Like this is your life you have to live, right? You have to live in a place, right? We're not in the metaverse and can just be in the matrix and upload our consciousness. That's not happening at least anytime soon. So while we still live in, the real world, or what people call meat space, we have to do this. And so, I think housing is still a very relevant thing for a lot of people. So it's something to keep in mind. And lastly, going back to that chart we showed earlier, is just that we have real estate is a huge investment for those that even have, $1 million to 10 million or 10 million plus. You see it makes up a very large portion of their portfolio. So you can see like this change, or this kind of transition from, oh, it's my primary residence, to, oh, it's a big portion of my overall portfolio, right? So it's something to keep in mind. You see kind of these shifts over wealth levels. That like, okay, well, if people are investing in real estate, like those people generally have more wealth. So if you have clients or prospects with, over $1 million, et cetera, they're more likely to do it as an investment versus people who are just going to have it as their primary residence. And so, yeah, sorry, I said lastly, but this is the actual last thing I want to talk about. There's this idea from, once again, this economist I like named Steve Randy Waldman, who writes this blog, Interfluidity. He has a post called "Home is Where the Cartel Is." And I love this phrase, this idea, and it's not morally great, but I think it's still true. And so we have to accept what reality is. And reality is, a lot of people, there's a lot of incentives to not have home prices drop, right? It's almost like a cartel. People that live in certain neighborhoods, they band together to prevent home prices from dropping. They block developments, they block, high-speed rail, all sorts of stuff. Whether that's right or not is a discussion that's to be had. I'm not here to have that discussion now, but I do think it's something that is relevant and matters. And because of that, it's very unlikely that housing is going to be a very terrible long-term investment. That doesn't mean that, oh, house prices can't drop another 10 or 20% from here. I have no clue, but I just think over the long haul, house prices are far more stable than people think. And we'll just go through an example. Like imagine the median US home price is 360. That's basically what it is right now. A 10% decline is negative 36K, 20% decline is negative $72,000, right? The median US household income based on the US Census Bureau is about 71,000. So to think about this in just like dollar terms, in terms of someone's income. Someone worked for a year, like they're going to lose like 1 year of their income. Remember, this is all after tax money too, but let's just pretend it isn't. Like there are massive incentives for people to not see their house prices go down, like in very, very big ways, right? And so there's a lot of things working together to prevent this from happening. And so because of that, like this is why housing remains a great investment, because people just won't let it be a bad investment because there's so much money tied up in it, right? And I think the best example of this, or most hypocritical example, I think it's kind of funny, comes from Mark Andreessen, who's actually a venture capitalist at A16Z, Andreessen Horowitz. He wrote this post in 2020. It's called It's Time to Build. If you guys haven't read it, it's actually very good. He's talking about like, hey, time to build. Like we have to really rebuild our society and do all this stuff, saying all this positive stuff. In particular, this is a little long. I'm not going to read the whole thing, but I want to read the part he talked about housing. He says, you don't just see this smug complacency, this satisfaction with the status quo, and the unwillingness to build in the pandemic or in healthcare generally. You see it throughout Western life and specifically throughout American life. You see it in the housing and the physical footprint of our cities. We can't build nearly enough housing in our cities with surging economic potential, which results in crazily skyrocketing housing prices in places like San Francisco, making it nearly impossible for regular people to move in and take jobs of the future. Okay, I don't want to read the rest, but you get the point. Like, he's like, we're not building enough. We need to be building more. He had this huge thing where he came out, it's time to build. Like, he had this huge, it was very popular when it came out. Well, guess what? A couple, maybe I think this happened 6 to 8 months ago, maybe a year ago. He lives in Atherton, California, which is like in Silicon Valley. They were trying to build a multifamily development in his area. And here is what he sent as a comment. This is what this person who wrote this blog post sent as a comment to the housing board or whoever the community board that makes these decisions. Subject line, immensely against multifamily development. I'm writing this letter to communicate our immense objection to the creation of a multifamily overlay zones in Atherton. Please immediately remove all multifamily zoning projects. They will massively decrease our home values, the quality of our lives and our neighbors, and immensely increase the noise pollution and traffic. Mark Andreessen. This is the same guy that says, oh, we're blocking housing development. We need to build, we need to do all this. And when it's in his own backyard, he's like, oh, no, we can't do this anymore. So I think this, and I'm not saying I wouldn't be like this either. This is not me trying to dunk on Mark Andreessen in particular. I think this is true of basically everyone. Everyone's willing to say, oh yeah, build something, but just not near me. As long as it doesn't affect me, I don't care. And so, yes, of course, if I was going to see my home drop by, let's say, $1 million in price, I would probably be writing an email like this too, if I'm being honest, right? And so I think you have to accept, like, this is how people work. There are massive incentives in housing. And because of that, that's why housing, I think, will remain a great investment, and it will not see, housing prices are very sticky, right? It's very hard to get them to drop because of things like this. And this is not great for a host of reasons. I don't agree with a lot of this stuff. At the same time, like, this is how people react. And until you're in that position where, like, oh my gosh, I'm going to see my home price drop how much? And I wanted to do all these retirement, like, you have all these plans. And as soon as something threatens that, you may react in a way that is like this, even after you publicly said it's time to build. So just something to keep in mind and something I wanted to kind of discuss here. So that's basically my talk. Those are the 3 points, the 3 big points I wanted to talk about. If you guys have any questions, let me know. But yeah, Lizzie, I guess I'll turn it over to you and we can go from there.
Yeah, so we definitely have some questions in the chat. One specific thing, guys, I just wanted you to pay attention to is that when we are presenting the facts to our agents and to our clients, one of the ones about supply and demand that he brought up that I thought was one of the strongest points is the increased, like, qualified buyers that will enter into the market when interest rates go down a point. Like, people forget, and the reason that we won't have a ton of inventory is because even if they go down a full point, people's mortgages are still less than wherever the current rate will be. Okay, so you have to remember that we are always in a supply demand market, and that is a huge data point when we're trying to present that to our clients. Okay, this particular chart. Thank you so much, Nick, for pulling this up. Nick, I know that you primarily deal in stocks. One of the things I heard you write about, or I heard you talk about and then write about recently, was time in the market versus timing the market. And I think it's extremely applicable when we talk about real estate, like that people are better off just being in the market for a very, very long time when it comes to stocks. But also you could see that owning a house for a very long period of time will typically show that it doubles in whatever you purchased it for, but also gives you that forced savings. Do you agree with that methodology? And Nick, you are muted.
Sorry about that. Sorry, everyone. Yeah, I do agree with that. I think over the long haul, like, I mean, if you're ever trying to build wealth, it's like you got to keep putting money into something. And, whether that means you're putting into stocks, you're putting into real estate, like, I don't think there's one correct way to do it. And there's a lot of people out there like, oh no, you have to do stocks. Like, real estate's too difficult for this or that because you have to deal with renters or whatever. It's like, no, there's a lot of ways to build wealth. You can do it in real estate. You can do it in stocks. You can do it and if you're being honest about this, you're being intellectually honest, like, there are rich people who did it from real estate, who did it from investing in companies, founding their own businesses, etc. So I think it is a definite possibility of something you can do, right? And so I obviously have no clue like what the future returns will be for the US stock market or US housing over the next 10, 20, 30 years. But I expect over the long haul that, these things will rise even with at least keep pace with inflation in the worst case. And in the best case, it'll actually grow. Right. And I think, people vote with their feet. Right. And so where are the countries that people are trying to get into, like globally? It's the US, Canada, UK, Australia. It's like mostly English speaking, like developed countries. Like there's a lot of movement and people are trying to get in here. And this is just like a thing that I don't think is going to go away anytime soon. And even people like, well, people talk about, the American Empire is going to end one day, or it's like, yeah, but like the British Empire ended, and did Britain be like go to hell? Like, no, it's just another country. It's just they aren't as powerful as they used to be, but they're still there. They're a developed country. They're doing well. Like, it's like I might see like just because, the US may not be the greatest empire ever like it was, previously, doesn't mean that, like everything's going to go to crap, for so to speak. So I don't know. I'm very like hesitant to give like very anti arguments about the future of the US, even if, for example, people are talking about like, oh, they're not using the dollar anymore. They're going to start using rupees in India and different currencies around the world. I don't think that means that's a huge thing for us. Like, I really am not that worried about that.
So when we are trying to explain this to clients, guys, and it's 7%, it's like now is better to start than 6 months from now when rates are down, right? We talked about opportunity costs with concessions, but also the sooner you can start investing, the longer it is, the greater the returns. Okay. Mm-hmm. Now, there's also been quite a few different articles on when they're comparing real estate to other investments, that real estate's really going to be like the gold standard as it stands right now. It's the most secure investment in terms of volatility. And we've noticed, and Lisa Wells is commenting on this, that there's been a bunch of articles about JP Morgan and hedge funds that are setting aside billions of dollars to purchase single family properties, which is part of our inventory issue, guys. Like, this is part of why it is so difficult for a first-time homebuyer to buy when demand is crazy. Okay, so just remember this, especially our agents. This is something. Can you comment on that?
Yeah, I mean, there's been a lot of, not only outside foreign investment, but there have been institutions that have been buying homes. And whether they're going to keep doing that, I have no clue. But that has obviously taken a lot of homes off the market, right? And that's why you see, I mean, if I can go back to, that's one of the reasons why you saw this rise so quickly, It's not just COVID. It's like there's a lot of other people that are buying houses. They're saying, oh, houses are safe. Like, the more like institutions like, yeah, why don't we buy houses? And so they might start buying single family houses. And so it really, distorts markets, right? Because I don't expect this type of trend to continue forever. Like, oh my gosh, this should just keep going up and up and up and up. Like, if you look at most of history, it's been like, look, there is a general trend upward, but it's not like the slope of this graph is what concerns me. It's not that I don't think they're going to increase. I just don't imagine them increasing at this same rate. Like, I don't think this slope makes any sense given this history, right? The slope looks more like this, which is more probably closer to the average, right? I think this makes sense to think about. Remember, this is just price appreciation. You have to also take into account the yield you get from like renting out the property. That's a very real yield, right? And so like 4 to 5% a year is not crazy. That's historically like even what like most developed stock markets have returned. So if you're getting 3 to 4% a year, you're saying, well, that's not a huge return, but it's something. And if you do that over a very, very long time, it adds up pretty considerably.
And so one thing that I want to make sure everyone understands is that like every market is different, every zip code is different. So here in Phoenix, our home like appreciation has been it's been in the double digits for over a decade, right? And so we definitely exceed inflation. This number, when it says 0.5, is a national number based on 4 to 5% appreciation after the rate of inflation, which has been anywhere between 2 and 4%, right? So that's why this is so low. And just remember that real estate, just like stocks, it compounds. So like the $300,000 that it is, this year with 5%, right? We're adding another, what is that? Like $15,000. So then it's a 0.5% on 315 the next year. And so that's why it grows so aggressively.
Yeah, remember, this is even after inflation, right? And I know most people, when they talk about percentages, they don't talk about inflation, but as you know, like inflation has been a very real issue. So like seeing it net of inflation, this is real growth. Like this is actual like growth. It's like having a farm and you have another acre, like an actual area of productive growth. It's not just like, oh, the number went up, but like I still have to buy, like all the prices went up too. So like it doesn't, I'm net zero. And like, no, this is actual growth, right? So I think that's the thing to keep in mind. And so this number seems small. Remember, this is only the price appreciation, does not include any sort of yield you get from actually living in the house or renting out that house, etc. But it's over a long period of time. So it's something to keep in mind, you know?
So Marcy asked, what are your thoughts on owning a property outright without a mortgage, right? So people who just buy it with cash.
I mean, if you don't want to, as I said earlier, if you don't want to deal with the mortgage market, like that's a great way to go. I mean, in terms of as rates go higher, like, and this is always this is a marginal decision at all points, right? If mortgage rates were, let's say 20% a year, I'm just throwing this number out there as an extreme. If they were 20% a year, then like having a mortgage would seem crazy. It'd be like having, $300,000 in credit card debt, right? It would be like, what? Like that just seems crazy, right? But because mortgage rates aren't that high, they don't seem as ridiculous, right? When it's 3%, it's like, oh, not a big deal. But when it's 20 or 20%, you'd be like, oh, I should buy all cash because I'm basically getting a 20% return relative to like going in and borrowing money, et cetera. So I think like when people like, should I pay down my mortgage early? Like if you have a high rate, like it's great to pay down your mortgage early. If you have a lower rate, maybe not so much. And right. And where is that margin? This is where it's being debated, right? Somewhere between 4% once you already get to 7-8%, and then where it's like, should I pay it off early? Sure. Or should I invest that money in stocks or something else, like, or another property? Those are the questions, and those are always on the margin. So right now it's 6 to 7%. Like it's a marginal decision. It's really the risk you want to take. Like paying off early and using all cash can be a great decision. For some people, they may say, you know what, I think I can get more in something else. And so they may want to put their money elsewhere. So I hope that answers that question, but it's really, it's on the margins. Wherever the rate is at a given point in time, that's going to determine whether it's clearly whether it's clearly like, use cash or clearly borrow. And right now we're kind of in that middle section a little bit.
So one thing that I want to point out is, guys, there's always an opportunity cost of whenever you use just cash. So that cash was invested in something else. So there's tax penalties of pulling it out of your investments. There's also the rate of return that you lose from not having the money invested. It's difficult in this point of time where interest is far exceeds, it's almost double the rate of inflation, right? So that is a difficult point when you're arguing the why leverage debt. But in most markets, guys, you can, if you leverage a mortgage, that loan depreciates over time at the same rate of inflation, right? So like you have to minus from the interest, the rate of inflation, plus the fact that you would typically have a housing expense and the opportunity cost of wherever that money would have been earning an interest in other investments. So this is a weird period of time because of how high interest rates are, but it won't always be this way. And most people, their houses will appreciate at the exact same rate, whether they have a mortgage or not. So when we're just talking about investment and rate of return, in most markets historically, it makes more sense to leverage a mortgage and have the money invested in things that yield a higher return. As you probably can tell, I'm a really big fan of Nick. I love the way he presents the information. If you have any questions about the data points or the charts that we put out, let me know in the comments below. I'd really love to do more videos like this. If you found them helpful, I'd love to bring more people on from Twitter or people that you find on YouTube. So let me know who you'd like me to bring onto this channel, to do some more interviews, to ask some really detailed questions. I want to make sure that this channel is so impactful to you on your home buying journey because we make smart purchases here. So hopefully you guys found this valuable. Don't forget to like, comment, and subscribe, and tune in for another great video.